From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for July 17th, 2020. Let's start with a little irony. A film producer working on a documentary on sharks was bitten by a shark on her day off. She could have used a bigger boat. And then the president of Brazil, a climate and COVID-19 denier, tested positive for the coronavirus. While in his first week of self-quarantine, he was bitten by his own pet emu. In a follow-up test, the emu tested negative. Okay, I made that last part up. Here's some proof that the world is coming to an end, maybe even tomorrow. Last week, we told you about the bubonic plague in Russia and China. Well, this week, a squirrel tested positive for the bubonic plague outside of Denver. I have a question. How do you get a job like that, testing dead animals for the bubonic plague? Well, scientists have discovered a new species of walking sharks. Just when you thought it was safe to go back in the water, now you can't even take a walk. And finally, some good news. This is pure genius. Johnnie Walker whiskey is going to be sold in paper bottles. You heard that correctly. Paper bottles that look like paper bags. Where was that when I was in high school? On the podcast today, we have Kyle Tetting, Brian Kilb, Steve Giles, Joel Dresang, and wrapping up the week, here's Bob Landaas.
Thanks, Max. NASDAQ lost a little bit of ground this week, down 1.1%, shedding 114 points, closed this afternoon, 10,503. NASDAQ's been on a tear this year, up, including dividends, 17.7% year to date. S&P stock composite 500 up 1.2% this week, tacking on 40 points, closed at 32.25. Positive now for the year, including dividends. S&P up 0.8%. If you look at the Dow Jones Industrial Average, pretty decent week. Added 597 points, up 2.3%. Still down 5.4% for the year. Dow loaded with bank stocks and oil stocks that aren't doing well. We closed at the bell this afternoon in New York with the Dow finishing the week 26,672. Kyle, let's take a look at, the markets responded very quickly to the news in California that they're rethinking their opening schedule. The market was way up on Monday. As you know, we lost all of it late in the day to finish up just 10 points. We have been way up. On Tuesday, the market jumped 556 points on fairly favorable economic news, and about everything is now hinged to the path of the virus. The economy's path is probably directly linked to that of the virus. We've seen a huge explosion of new infections, as you know, fell from about 35,000 a day to 20,000 a day. And now we're back up above 65,000 a day. We're clearly heading in the wrong direction. So the fact that the market is measured by the S&P, the broader market is finished up for the week is kind of a miracle.
I think you're right there, Bob. And a good part of what we've seen and what we're going to continue to see over the next couple of weeks is data coming in on clinical trials. And so you look at Moderna releasing some data, you look at AstraZeneca releasing some data next week. Now, all of this is not necessarily what's going to save us over the next month or two. We still need to continue to practice appropriate social distancing. We need to do all the things that the doctors are telling us to do. But I think that markets are looking beyond now the current crisis or the reemergence of the virus in the current crisis to what a lot of that data means for 6 months from now, a year from now, when we've started to get some better handles on what the vaccine looks like, what treatments look like. And so, I think it'll be interesting to see what some of the studies come out or some of the research trials come out with next week as far as data. But I think a lot of even the forecasts for economic data are hinging on what happens with this virus. And that's a big piece of the overall puzzle is how quickly can we have a vaccine and how effective is it going to be? And the other piece, of course, is how quickly can we get it out to people? And so, I think really challenging short term in terms of what the economy looks like, really challenging short term in terms of what earnings look like, just because the virus continues to force businesses to close down again now. The virus continues to force, I think, people to step back some of the going out that they had done. And so challenges there. But overall, I think if we can keep a long-term focus, there are some positive signs. It just means, I think, that for a while, we're going to continue to face a lot of volatility.
I'm talking to clients every day, all day long. And, my sense in talking to everybody is that there's this sense that people can't understand why the markets come back when the economy is doing so poorly. And, it's so important to focus on the stimulus spending because that's what's supporting the market. It's not the economy. We're still in pretty tough shape, but stimulus spending has been gigantic. The financial crisis, we spent the equivalent of 1.5% of GDP getting the country back on its feet. Now we're already at 4.5% of GDP for stimulus spending, and we're not done yet. So you get this idea that potentially some of the direction of the market this fall is going to be driven by how much more the government will provide for stimulus spending to get us to the point where we do hopefully get a vaccine. Fed governor the other day warned about the potential for a double dip. She said that fiscal support is going to remain vital. Data tracked by the Fed suggests that the strong job growth in May and June may not be sustained. Brian, what are you telling clients these days relative to, an enormous amount of stimulus that brought the markets back? Most clients are even or slightly positive, against a backdrop of pretty discouraging economic news.
Bob, I think in the short run, I think the news is fairly encouraging in that the market reflects a pretty strong valuation and people's portfolios have held up, I think, remarkably well. So in the context of some of the challenges that you talk about, should, as Kyle suggests, we get a vaccine, should we get through the next wave of COVID and come out the other end, there are some challenges long-term in terms of trying to figure out how to make our way through the debt and determining how the economy gets back to some kind of normal, whatever that new normal is. So I think it's a little bit of talking out of both sides of my mouth right now, in that I'm encouraged that the market has held up well, but I do have some concerns about where we're going here. And I think it's unusual to some degree that the valuations are as strong as they are. And while that's good in the short run, that probably also creates some challenges in the long run in terms of seeing market returns. So kind of a big mixed bag for me, but I think I'm more inclined to be a little bit more cautious than I normally am right now, because there's just so much uncertainty. Things could fall any number of ways from here on out. And yet I think Wall Street's reflecting a pretty optimistic take on things right now.
Brian, you've spent years talking to our clients about the relationship between interest rates and stock prices. And year after year at the seminars, you spoke very concisely about the relationship. It certainly matters now with interest rates so low, 10-year Treasury at 0.6%, 30-year Treasury at 1.3%. Clearly interest rates at these rock bottom levels have to support higher multiples for stocks. And you hear all sorts of folks say there's nowhere else to go with money right now but stocks because interest rates are so low. Just spend a couple of minutes talking about that.
Well, the market is indeed a discounting mechanism. So you're buying future earnings in that company you own or the basket of companies you own in your portfolio. And so as we look ahead, certainly the earnings number is a big variable. We're starting to get second quarter earnings in now. But as you start to kind of narrow in your focus on what those earnings might be, then as you take a longer look and discount those earnings, the interest rate matters significantly. And if you have a lower interest rate, if you just do the math, it allows for you to pay more for your investment today. So you can justify higher multiples in the short term, because of the lower interest rates, I think the question then becomes, what are the challenges down the road as interest rates rise and as earnings are as nebulous as they are right now?
Steve, what's your take on current events?
Well, I continue to remind clients that the importance of a balanced portfolio is to help us get through periods like this. A lot of my conversations, Bob, are revolving around how well everybody has held up. I think that most investors recognize that this genie is out of the bottle, so to speak, and we just have to plod along until we get through it. As Kyle alludes to, optimism with some kind of vaccine and immunization, but not knowing what that time frame is. And just thanking our lucky stars that for those who have to take money out of their portfolio to supplement things like pensions and Social Security income, that they've had balance and that they've had diversification to continue to provide that cash flow.
Joel, let's bring you onto the program. First-time claims for unemployment insurance, 1.3 million. Last reporting period, slowly trending downward. Still pretty big number, though.
It is, Bob. So before the pandemic, 300,000 would have been a big number. And we've had 1.3 million. That's the lowest that we've had in 17 weeks. So, and we're actually kind of steadying off. So much for the V-shaped curve. We've seen the spike go up, and the latest numbers show that 32 million Americans are receiving unemployment benefits of one kind or another, and that includes people getting special pandemic relief.
So, the quick version of the job story is that we lost 22 million jobs in March and April, created 7.5 million jobs in May and June. The way I do math, we're still we've still lost over 14 million jobs. Unemployment rate came down from a high of 14.7 in April. The latest number, 11.1, still gigantic compared to the unemployment rate, way below 4% for the last number of years. We got a ways to go yet here on the jobs front.
That's right, Bob. Depending upon, as you were saying that so much is hinged on what's going on with the virus. We've had, I saw a report from CoreSite Research today that said that they forecast that 25,000 stores are going to close in the U.S. this year. That compares with less than 10,000 in 2019. And you think of all the jobs that have been lost so far. We saw research that suggested that 40% of those jobs might never come back. So that's actually a big, long road to go down yet.
I had a conversation yesterday morning with a client, an infectious disease specialist. Another conversation with a client, a doctor out in San Francisco today. We were talking about the vaccines. They're both fairly encouraged by what Moderna is doing. But what I understood of the conversations was that the vaccines may not produce the antibodies for more than a handful of months, which seems to be the current problem. But they were both optimistic about ultimate delivery of a vaccine late this year or sometime next year. Maybe that's what the markets ultimately are reflecting, that eventually we'll get one. We're still down 12%, give or take, from the highs that we enjoyed briefly early February. Kyle, I've talked for years about how accurate the market is as a pricing mechanism. You mentioned on this program a couple of weeks ago that according to FactSet, S&P could earn $163 next year. Give or take, that's what it earned last year, excluding negatives. And maybe the market is properly priced now, down 12% off its highs, considering the obstacles that we still face.
Such an interesting point that you look at the direction of earnings. We're down 40% in the second quarter, year over year, of what we're forecast versus where we were last year. And so, I think if you wondered, okay, why did the market fall as much as it did? It fell as much as it did because people began to see that earnings were going to fall apart. And here we are in the midst of that. We're now 10% through the second quarter earnings reports. Obviously a long way to go, but I think we've all got a pretty good idea of where we're going to end up at this point. And people are, I think, rightfully looking to what does next year look like? What does the following year look like? Because it's a very different environment in 2021, 2022 than what we're operating in today. And so you look second quarter forecast for 2021, we're talking about year over year 60% earnings growth. And so, I think the question is, why did the market recover as quickly as it did? It's because people got beyond the news today and they started looking at what does this look like when we get to a point where we can even return to some semblance of normal. Now, keep in mind, 60% earnings growth next year in the second quarter doesn't get us back to where we need to be in terms of the longer term trend, but it at least gets us back in the right direction. And so, I think we look at the progress of earnings growth right now and how much of, kind of the market's earnings have been destroyed. And you have the conversations like Joel had about businesses that probably aren't going to come back, about jobs that probably aren't going to come back. That's going to do something to earnings. But it also means that, at some point in time, those jobs that do come back get added back to economic growth. They get added back to earnings growth. They get added back to an economy that I think is ready for them when the time comes. And so, I'm encouraged by the direction of earnings. You mentioned, that by next year we should be back to last year's earnings numbers. Strangely enough, the market is roughly flat for the year now. And so, if you look at kind of long term what the forecasts are, I think you're absolutely right. They tend to even out. It's just that nothing happens in a straight line for investors. There's so much volatility around the direction of earnings and so much volatility for the markets around the direction of earnings that, you can't bet on any one quarter being the thing that's going to save everything. And so, I think the news is going to continue to be bad for a while in the second quarter as we look at the other 90% of earnings still to come. Third quarter's not looking all that much better for earnings, but as we start to get further away, as we distance ourselves from this crisis, I think the hope is that we get back to a more normal direction for earnings growth. And, I think the markets are reflecting that.
I also think it's important, Kyle, that we have to remember that human beings are emotional and we often are victims of our most recent perceptions. So while we're living through this pandemic and the weight of it is at times overbearing, we all recognize longer term that we will get through this. And as investors, we know that our time horizon is long enough to withstand periods like this. It's just frustrating to have to deal with it on a day-to-day basis.
Steve, we talked about the stimulus and what that's done for the economy so far since the pandemic, but there's also that psychological aspect that you talk about. I stopped into a donut shop yesterday, and the guy running the counter said that things were going great, that business was really picking up, but, and he looked kind of green. He said, I'm afraid that we're going to shut down again. I'm afraid that these viruses are going to make us shut down, and people are going to stop stopping in and getting donuts.
Joel, that it speaks to the point that I wanted to raise. And I think for as long as I've been doing it and you guys have been doing this, I don't know how you feel, but it seems to me that there's more uncertainty in the news and the data and how people feel, this lack of clarity about things that, even when you talk to your donut guy, he feels good, but he's worried. We talk about COVID data and we're not, we get all this conflicting reports. We don't really know how to process the impact on the economy of what COVID's done. We have an election in the fall. That's always, a mixed bag of stuff anyway. So I do think when you fast forward to earlier next year, especially if there's a vaccine, that vaccine would be one very tangible thing that gives you kind of that mental safety net, I think, and then you're past the election and you've already had maybe a couple quarters of post-COVID economic data, and you have a much better sense whether we're making progress or things are worse than we thought. And so I think if the markets are performing fairly well now, and it buys us a few months to get through this extreme period of uncertainty, that if we come out the other end and we can feel better about things, we may set ourselves up for a year that's better than we think right now.
Brian, I'm chomping at the bit to look at some of the value funds out there. dispersion between growth stocks and value stocks extreme. We get the infection counts down quite a bit. I think that might be a window of opportunity, perhaps. So, folks, historically, when we go through a bear market, investors flock to the value stocks. Banks, insurance companies, utilities, telecoms, boring stuff, slow growers. But they're the worst performing category of the domestic stock market right now. Counterintuitive. Growth stocks are leading the list. They usually get clobbered in bear markets, sink like rocks. Not this time around. A lot of these tech names, their revenue streams weren't interrupted at all because of the virus. So I think that, that could be the next leg. I love trying to get a deal on what we buy. Might stay a deal for a while, might become a better deal. But take a look at the major money center banks. A lot of those stocks still 30% or more off their highs for the year. Look at oil and gas. Boy, that was pummeled. Even the utility stocks that are, dependable dividend payers, they didn't hold up well this spring. Insurance companies, a lot of the major insurance companies aren't selling life insurance anymore to people 70 and older because of the virus. So their revenue streams are being hit because of that, among other things. Banks are going to struggle with, there's no spread on money, hardly. They play the spread. And when the spread's small, then their earnings take a hit. But what do you think about shopping in the value space?
Bob, I think your point's pretty interesting. And I think if you go back to a day like Tuesday of this week, you mentioned in the open, Netflix was down like 8% on Tuesday alone, I think. And could that be a reflection of what may be a longer term trend when things stabilize a little bit? That you have these very pricey, very few select companies that have really sustained the market over the last few months and years. But there's only so far those big guys can go, and there's only so much they can grow, and so much you can, buy into their stock price. And at some point in time, because there is all this money out there as a result of the stimulus and other factors, where's it going to go? Then you start shopping around for the cheap thing. You start shopping around for the thing maybe that has less of a downside, that maybe pays a little bit of a dividend, that maybe provides some stock exposure, but not the sense of risk that you've been taking in some of these other asset categories. And I couldn't agree with you more that there's going to be some opportunity there. And I think some places to do a little bit of shopping for sure.
And unlike individual investors, Brian, big money is unemotional. Those mutual fund managers are going to go where they see the deals.
And I think just the way we're wired, certainly the way I'm wired, is I like to get a deal, and I like cheap things. I like certainty, which is not to say I don't take risk. It's not to say I don't, but I think that's a pretty enjoyable way to make money for me. When the markets do cycle back to the value side, I'm going to kind of enjoy that.
Brian, you mentioned dividends earlier, and then you mentioned risk. And I think you look at, some of those value plays, some of those dividend plays that are out there, they are far safer in terms of price movement than much of what you see, far safer in terms of the actual dividend that's being paid than what you see in lots of other areas of the market. And so you look at something like a utility stock whose returns are basically contracted with this state. As long as it's a well-run company, as long as they've got good cash flow, those dividends are going to be pretty solid. They're going to be pretty safe. And you're seeing upwards of 4% dividend yields on some of those companies now. And so, if you're looking at bonds and you're going, I can get 1.5 on some pretty safe bonds, or I can get 4% on a dividend on a utility stock. Yeah, keep in mind that utility stock is going to bounce around like crazy. But if you put enough of them together in a portfolio, in a fund that, I think looks for those attractive opportunities, you can get a pretty attractive dividend yield now from stocks that long-term is going to add value to your portfolio, even when the markets are down, even when stock prices are down. So I think it's not strictly about, what's the dispersion look like. It's also about the fact that at some point in time, value stocks become such a good deal, and the attractiveness of that dividend relative to other opportunities out there becomes so attractive that you just want to add it to your portfolio.
Brian, I'm still thinking about the albino chipmunk that you saw in your yard. I think you ought to take a video. Do a video. I bet that'd go viral quickly. I've been watching chipmunks my whole life. We have dozens of them here on the property. I've never seen one that's even close to looking like albino. You might have a 1 in a million there. I'd be shooting video until it gets dark tonight.
So I went into stealth mode and crept up behind a tree and got a picture of it. I'm going to send it to you.
Yeah,
I didn't know video, but I got a pretty good picture. So.
No, that's a step there. That's great.
That's the kind of stuff we're doing in COVID right now, right?
Yeah, well, it worked for me as entertainment.
Yeah, me as well.
Okay, folks, that's the end of yet another Money Talk. Thanks for listening to us. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.